Hello and welcome to The Road to Autonomy. The Road to Autonomy is brought to you in part by Stantec Generation AV. Stantec Generation AV combines some of the most experienced AV experts in the industry with the resources of a global engineering firm. Stantec Generation AV provides education, consulting, assessment, and guidance to any industry interested in autonomous vehicles. Learn more at stantec.com. Hello and welcome to The Road to Autonomy. I'm your host, Grayson Brulte. On today's episode, we're absolutely honored to welcome Ed Walker, Vice President, Shared Economy and Mobility, Hub International. Ed, welcome to the podcast.
Hey, Grayson. Good to see you.
It's good to have you here because without insurance, there's no mobility industry. You assess risk, you price risk, and without that, we're not going to have a mobility industry. And as it relates to insurance, what is the current state of insurance for the gig economy, which is one of your specialties?
The current state of the insurance for the gig economy. Yes, I mean, your comments are absolutely correct. It can be either the solution to or problem for any operator in the space if not managed correctly. And I'd say the current environment is a really broad spectrum of winners and losers. And I don't necessarily mean to put a pejorative context on it, but more so of the individuals who have focused in and taken the reins and invested in their business and controlled their losses have seen that manifest itself in recent days with, nominal increases or flat, or even sometimes in the situation where certain criteria are met, some decreases in an automobile liability market, which for most of mobility that we're discussing, scooter sharing falls into general liability. But for most of our conversations, the auto liability market is in an upward spike. We're talking about an average across the industry increase of about a 10% increase. So when you have figures and loss figures running up, fraud running rampant, it's really difficult to control. But you do have, again, like I mentioned before, you have operators who've invested in claims management, who've invested in driver behavior scoring, and who've even invested in who they're either renting their cars to or letting drive on their fleet, or letting perform their services, or letting, deliver goods from various vendors. They've done their research on who they're bringing on, and that's really, manifested itself in a much brighter outlook than other folks in the marketplace that have maybe let those pieces of the risk management equation sort of slide by the wayside and find themselves in the 120, 140, 160% loss ratio world, which for any of your listeners basically means that you're that much higher than the premiums you're paying in. So naturally, we want to be under what the amount of premiums we're giving to an insured, an insurance company, in order to facilitate what would be considered a lower rate at renewal. So if you're coming in at a higher click than that, it's time to get to brass tacks. It's time to really invest in how are we going to fix this and clean this up.
The 10% increase in auto liability, how much of that is driven by one, fraud, and two, uninsured motorists? Because it seems that with an economic downturn, the first thing to go is your auto insurance, which says, what do I care? That seems to be a common trend, unfortunately.
It definitely does. So there's a lot of things to play into that. There's actually a really odd statistic, too, that I recently came about, which is 10% of all claims filed in 2022 were fraudulent. So we have average of 10% increase, average of 10% fraud with all claims. And that's across the industry. It's not just auto, but a lot of these tend to manifest themselves in auto, especially in at-fault states and various different regulatory implementations or guidelines, such as like Florida, where even if you were at fault in an accident, you technically have a lot of rights to collect from the not at fault party for certain situations. Where a lot of this stuff is bringing to the fold fraud because the system is enabling it to an extent. A lot of these states will, and I don't mean to necessarily pick on Florida, there's many states doing it. A lot of these states will also come back and say, well, we've invested resources in tackling and going after these types of individuals. And there are individuals across the country who actually deliberately cause accidents in order to cash in on the insurance, especially in these states where they can collect on insurance regardless of fault. So the onus of proving liability there doesn't even matter, which really, as you can imagine, naturally invites these kind of bad players to the marketplace. And so it's a place we really got to get smart on. There's so many angles that are pushing the auto liability industry in a negative direction. And by that, I mean higher premiums. We need tort reform. We need changes in the way we address certain, niches of automobile liability. Maybe this stuff can fit for personal lines and and regular driving on the road for leisure. But, is this a fit for gig, for the rideshare world? I don't know. I can't say that it is. Some reform definitely needs to occur if we're going to expect these operators to continue to ensure their operations legitimately. Because as you pointed out, it's an easy thing to throw by the wayside. And I think I mentioned earlier too, it's happening at a higher click, both from customers and from operators. From a customer perspective, there's more people on the road today. And by customer, I'm sorry, just meaning just everybody. There's more people on the road without insurance than there ever has been right now in the United States. Underinsured and uninsured motorist coverage, which is not provided in every state, has become what used to be a consideration on a renewal. Like, hey, we're in some states, we might want to consider this. Maybe we want to pay a little extra premium, to an absolute requirement, in my opinion. There's not a single auto liability renewal I had in the last 2 years where I haven't said and reiterated, we have to actually encourage you to purchase this coverage because there are so many people on the road without it. And Grayson, I want to actually also flip that on the other side of operators. A big trend these days, between whether it be rideshare rental subscription models, has been the bring your own insurance concept. And while I certainly can appreciate it, and Hub actually, I'm really proud of what we're doing. We have a lot of technology systems that can actually enable such a system to work seamlessly. The problem with the system itself is the insurance market we're dealing with. And what I mean by that is, when you have a bring your own insurance model, what you have is a subscription model where the car is not owned by the customer. However, that customer is going to a personal lines agent or program in order to get the vehicle insured. And by the way, what makes matters worse in this situation is that they can get the policy. And why I say that is because if that individual renting from a subscribe 18 months, I want to try an EV, totally innocent situation. And I love these models that are getting people into EVs. I think it's a good way to do it at a cost-effective price point. But when you make this change, you have to remember, on an insurance contract for personal lines, if you are not on the registration, so if I'm a customer, I rent a Tesla from a company for 18 months, I want to check it out. And they ask me, hey, go get your own insurance. And I go do that, and I'm not on the registration for that Tesla. Any insurance company, even if the policy was delivered to me, even if I have it in my hands, even if I pay my premium, any adjuster can come in and say, we are not paying any claims on this risk because you are not on the registration. And so that is a very risky situation to find yourself in. Now, I don't want to be all doom and gloom. If you have a fender bender, is it going to be covered? Probably. Your insurance company is probably not going to send out their A-plus person if you have a pretty minor accident. But if you have a significant total, if you have bodily injury, you've got third-party liability considerations, you're going to get higher level claims adjusters coming in there who have no duty whatsoever to pay your claim because you're not on the registration. And that's both useful for everybody in the US to know as we come closer and closer with these models, but it's also useful for maybe some operators to consider if they're thinking about this avenue. The realistically only way to do it, and to do it flawlessly, is to put these subscribers on the registration for the vehicle, which admittedly, in their defense, is a difficult endeavor to do. It kind of ruins their autonomy of running with a short-term lease subscription model because they've transferred more financial ownership to the customer, which in their business use case is not what they're trying to do, among other considerations. But so you've got both of those sides there pushing on top of fraud, on top of legitimately bad claims. And, you've got yourself a nice little hurricane here within an earthquake. So not the best analogy in the world, but certainly a tough market to be in these days.
Do the subscription companies act as the financial backstop from an insurance perspective? Because the vehicle gets totaled, it essentially just goes back to the subscription company and you get a new one tomorrow. Or that goes back to a reinsurer? Or where does the buck stop as it relates to the liability and who gets paid?
It depends on the company. So it depends on the subscription operator's true ownership of the vehicle. Are they working through an MFC in order to get vehicles through a purchaser? Are they technically leasing the vehicles from a different B2B arrangement? Do they own the vehicles outright? And quite frankly, those are the safest bets, is when they own the vehicles outright. When you're talking about probably safer bets in the space, you're talking about the OEMs that are running these programs. They have a financial duty to do this the right way. They have a practiced expertise of doing this the right way, and they have the full ownership of the vehicle, which gives them a lot more capabilities when it comes to potentially putting people on the registration or not.
Okay, well, let's geek out for a minute. What happens to the liability inside the vehicle? Somebody gets injured, somebody gets hurt, if you're in an Uber or Lyft, they get attacked by a driver or an incident that's heartbreaking, whatever it might be. Who's responsible for covering that from an insurance perspective? Because you have medical costs, somebody's going to come saying, hey, I'm suing you, you got to pay.
Well, I know various TNCs have different buckets they can pull on in that situation. Generally, there's also over-the-road coverages you can get as a passenger. There's few companies that will give you additional accident, AD&D limits that you can purchase per Uber trip or per Lyft trip, which is a smart decision to make. In the situation where a driver gets injured, that would technically be either an occupational accident or workers' comp claim, depending on if the driver's a W-2 or a 1099. Most drivers are going to be 1099, so that's probably going to fall under an occupational accident coverage purchased by the operator in question. And that's one of the things I think we've gotten right with Prop 22 and AB5 is that we've struck as long as things hold where they're at right now, it's a very solid middle ground and affordable protection to provide for 1099 drivers that actually within the realm of insurance is a pretty soft market these days. So it's relatively inexpensive in the grand scheme of things. So when it comes to driver protections, that's in there. One of the things that I think customers of the gig economy should be wary of is there's a very drastic difference between companies that purchase what's called assault and battery or a SA&M in corporate insurance. And that's usually that it's excluded from most general liability policies. It usually needs to be purchased monoline as an additional coverage. And this is for companies that have a little bit more of an exposure to violence or have had claims where assault and battery is involved. And I bring it up because it is a separate category of loss now within the scheme of ride sharing that has been tranched out into a new insurance product. And the reason that's happened is because the losses were so considerable that's how insurance evolves, by the way. If it used to be endorsed on a GL, and what happened is GL was being drastically overpriced because it was being endorsed automatically under GL because that's a standard ISO edition. So what happened is companies realized we can't do this anymore. They moved it off, and now there are carriers writing it monoline that will provide that protection should you as a customer get attacked, abused, or sexually harassed. To an extent, that's another policy, which could be employment practices liability, if that covers independent contractors or third-party situations. But there are various coverages. Some of these are discretionary purchases. So it depends on the operator in question. But I could safely say that's a good question for you as a consumer to ask, especially if you're talking about, am I going to send my child on a gig ride to school, to practice, so on and so forth. There's a spectrum of purchasing decisions there. Not all of them are mandatory purchases, and that's something that consumers should definitely be aware of.
Who's underwriting these new insurance products? Is there certain underwriters in the market that have more of an appetite to underwrite this type of risk versus others?
This particular side of the risk, there are a few carriers that are willing to do it. The marketplace for it is, I would say, in a kind of a plateaued state where it's a pretty static group. There are, due to marketplace pressures, there's been, despite rate increases across the board, there has been an increase in competition as of late. So what you've seen is that has brought forth the right results. That's brought forth some carriers that are sneaking in little sublimits for assault and battery, for example, to general liability coverages, sort of inching their way back to the old way of doing things. So it's readily available. It's an extra cost point, I think, across a risk management decision. Depending on your size, it could be a rather nominal addition to a significant fleet. But again, if you've had issues with it in the past, if you have a bad loss history for it already, it can be difficult to obtain. But it's a very cultural purchase.
The bottom line is good insurance is expensive, but it does a good job. You mentioned auto liability insurance going up by 10%. I'm really curious. There's millions of individuals around the world that drive for Uber and Lyft and DoorDash, Uber Eats, et cetera, all the gig stuff. What percentage of their take-home income is going just to pay the insurance?
Well, I can safely say that anywhere outside the US is going to be better. Their take home is going to be much better. And that's unfortunately due to social inflation and our culture as Americans to sue everybody. Not to be too super off the cuff, but we just as Americans have a general tendency. I speak as a total patriot, but we as Americans have a very legislative attitude when it comes to things like this, and it's resulted in, if we're talking about driver pay, less pay per mile in the States due to those accidents, due to that fraud, due to a number of the items we've already discussed. I would say, depending on state, the insurance is costing your operation anywhere between 10 to 40 cents per mile, depending on state and depending on the carrier. And so when you throw that together in a 7-mile trip, we're getting close to $1.50 maybe if we're getting, bigger trips per, is that going to add up over time? Of course. And the unfortunate part about this is that those rates are highly subject to volume. So what happens in the situation is a lot of your smaller regional transportation network companies who don't have, really large mileage pools are actually paying a higher price per mile just because they haven't met the actuarially defined minimum premiums that a lot of carriers charge. So they sort of have to take the pound of flesh up front while they grow their operation, which, is no easy feat.
10 to 40 cents a mile for insurance. Okay, you're going to factor in gas. So let's just factor in gas for simple. Let's say 25 cents a mile based on petroleum prices. What does a driver get paid? What is Uber and Lyft paying them per mile? Is there an industry standard or an average?
I am not an expert on exactly how I know they differ greatly between operations. I know I know that there's a strong push lately for more of kind of a driver subscription, like a rolling month over month. We will retain you for X. A lot of people are trying to play with the price model in order to attract drivers. I think there is no easy solution to it. I think as of late, it does feel as if Uber's been doing a pretty decent job with it. They've certainly won over a lot of market share here where I live in Los Angeles. That doesn't necessarily mean they're treating their employees the best. But
okay, so Ed, that's really interesting. Let's do some simple back of the envelope math here. So 65 cents for gas and insurance. Let's say the driver makes $1, just using a round number. They're only making 35-cent profit before tax. And let's just say take off another 10 cents for tax. And now you're at 25 cents. Okay, so you're not making much money. And to me, the other big concern here is, this is data according to the American Property Casualty Insurance Association, reported that U.S. property and casualty insurers recorded a net underwriting loss of $26.9 billion in 2022. I repeat, an underwriting loss of $26.9 billion in 2022. That's real money. So now you have a 25-cent hypothetical margin. You're going to tack on insurance, let's say with the increases. Now you're at another 5 cents a mile. You're making 20 cents a mile. Why would anybody want to do this job?
To answer your question, Grayson, it really isn't sustainable. So something has to change. I see this as a really good opportunity for autonomous vehicles to enter the fray, at least to make a dent on the gas side of the equation, maybe even improve the telematics side of the equation. You got to remember a lot of the pieces of insurance that don't necessarily come together as well as they should for shared economy models, autonomous models, subscription services, so on and so forth, is the data requirements behind it. Like the actuarial tables of how to manage this risk are existent. They are not rich with data, at least at this point in time, to the extent where most carriers can make reasonable estimations about proper premiums and so on and so forth. So I think that enter that world of lower emissions, lower costs for fuel, and better data behind every single trip. And I think you've got at least what looks to be the beginnings of a solution. You mentioned the big underwriting loss. One of the things people don't factor into that $26.7 billion in underwriting losses or whatever it was is that was 6 times higher than 2021's figures. 6 times higher. Okay, so it's gotten that much worse over the course of just a year, which is unprecedented. And so some of this has just got to be up to us as consumers. Whether we need to stop suing people because, I broke my foot in a fender bender, whether we need to have tort reform, or whether AVs will come in and solve the gas equation and provide better vehicle trip data to the point where we can really price and manage these systems. And maybe even autonomous vehicles can come in and fix that safety and driving problem for all of us. Depending on how close we are to that, something's got to give.
What caused the $26.9 billion underwriting loss in 2022? Was it the tort issues, or was there, obviously we had hurricanes, but what caused that loss that was 6 times larger than 2021?
It was a blend of everything you mentioned above, as well as really kind of catastrophic lawsuits. We're talking $10 million plus settlements, trucking, transportation, and the like, where the legal teams in the situation have dug their heels in and gone after the biggest bucket they could, and they managed to get it, which is a grow. I mean, again, I don't want to discount the earthquakes and the hurricanes and the natural disasters we've encouraged, because that impacts insurance on a macro level as well. But if I'm sticking to what I know in my lanes, I can tell you that the growth of these severe $7, $8, $9, $10 million plus settlements, the average monthly determination of these is going up. And a lot of these are with insurance companies that have maybe even just gotten into the space or trying the space. And what does this do? This not only is a claim that's paid out. This is not only an underwriting loss. This also just taught a new carrier maybe, or a carrier that's been in the space for a while, hey, we just made a huge mistake. Hey, we need to readjust or revisit our underwriting, our actuarial tables, because we can't predict this environment that we're in here. And Grayson, one of the terms I like to highlight within that conversation is what's called social inflation. And I maybe have talked to you about this before, but really the bottom line of that is, a claim 10 years ago that would have cost $5,000 today will cost $50,000. And that is the getting back to what, again, I'm not going to discount the earthquakes, the significant natural disasters that have occurred, but when it comes to year over year behavior, I couldn't say could you say there were 6 times more natural disasters last year than there were in 2021? I certainly could not. I don't think that's the case. I think a lot of this is coming down to these massive awards in court for claims that 10 years ago would be maybe even 100th of that price tag.
It's interesting. We do need tort reform. Let's just cut to the chase, and then I'll repeat. We do need tort reform. If you look at one of the biggest opponents outside of the Teamsters against autonomous vehicles, autonomous trucks, you guessed it, the trial lawyers. Their ability to sue is going to go away. So they're suing left and right on the automobile, the general liability aspect, which you call GL. Does that all suddenly just force the hand of autonomy and accelerate it because these rising costs, and autonomy is not going to incur those costs, and here's autonomy as the affordable option? The people that were against it actually drove the adoption of the technology.
I think it does. I think it does on a lot of levels. I think it solves, of course, subject to its continuing development, because I do think autonomous does need more time to grow and breathe, needs more, couple 100,000 more, maybe 1 million more trips to round out. But like I've told you in the past, like one of the things I think the trajectories we are on in an insurance capacity is a couple of years ahead of us of maybe privacy discussions, being that, some of these telematics, some of these plugins, you go to Progressive, Allstate, and so on and so forth, they'll give you the option now to plug a dongle into your car. Question is, does everybody want to do that? Do you feel, how many people are going to plug that thing in and have no concern whatsoever? I know personally, like I've tested them out many times. I test out a lot of our partners with their onboard cameras, and I don't drive much different than anybody else, but it still made me a little nervous plugging it in. So I think we're in a direction where we're going to stumble into some privacy considerations because the market requires it. If you want to pay less in insurance, on a personal level, you're going to start to have to invest on that, and that investment might be giving up a little bit of your freedom on the road for our heavy pedal or heavy footed listeners, but which I ultimately think will move into an era where autonomous vehicle companies can actually codify and depict their safety versus a human being, and they can do so in almost a clinical fashion. They've gotten so good at this that they can really, the hard numbers say we are X percent better than your standard human being behind the wheel. And that's where I see us going. And that's where I think insurance is a cyclical economy. I'm hopeful for a plateauing of prices. The trends are not suggesting that. I see autonomous vehicles as our ultimate light at the end of the tunnel if these situations don't improve.
Let's just cut to the chase and the facts. Autonomous vehicles don't get high Autonomous vehicles don't get drunk. Autonomous vehicles don't get drowsy. They have one job is to get you to and from your destination safely, and if your cargo to get you safely. And then the other benefit, because we're talking about insurance here, autonomous vehicles, they eliminate fraud in the system. You see these incidents where these not so nice individuals, who, let's just say, I think I'm clever, they pretend to get hit by an autonomous vehicle. I'm going to sue. All of a sudden, the AV company goes to the judge or to the lawyers and during discovery. Here's the video. This was all staged. Oh, okay. Think about how much fraud that AVs will get out of the system. As we flush the fraud out of the system, will auto liability go down?
I do believe so. Yes. But what I think we'll see is, because AV adoption is occurring right now. You've got your brands in San Francisco and I believe in Pittsburgh, and there's been some that have been shut down as of late, but the innovation is there and the product is there. It's depending on where you live. And I think more time and investment in it is going, right now, I think prices are going to see a spike. I think they're going to be generally, I think the statistics come down to EVs in general, because a lot of the EVs in circulation in the US have autonomous capabilities. Generally come in at about 26 to 27% more expensive from a regular insurer standpoint, from just go to State Farm, Progressive, whatever. But I do see that eventually, as the data becomes more reliable, dipping down to a point where it is, from an actuarial perspective, from an insurer's profitability perspective, an easy calculus. And that's a far cry from where we're at today. And I think that is one of the really bright things that autonomous vehicles can bring to the equation. Do I think there will be bumps in the road? Without question. I hate to use a Tony Stark analogy, but I do think that there might need to be some broken eggs in this situation in order to get us to the eventual goal. But that's what we're going to have to invest in. We're going to have to invest in time and patience for the technology to get there, for our culture to really adapt to it, rather.
But the autonomy is coming. It's going to change every aspect of our society. It's going to change how you and I go to dinner together. It'll change how we get our food delivered to us, or how we farm our food. What we do know is that autonomous vehicle companies are going to get very large. And when you become very large, you have financial resources. And with financial resources, it allows you to self-insure, and you can put a reinsurance backstop on there. If that happens, what happens to the P&C market if all these big potential liabilities start self-insuring?
Well, don't forget that even if they start self-insuring, they still need to be backed by reinsurance. So they still need a structure in place. They still need a backstop. Fully self-insuring at a corporate level is not going to be, at least in today's environment, up to par with many state rules and regulations. Not to mention, there's only so much, insurance you can predict. Their auto liability is one consideration. When I think about autonomous vehicle companies, one of my biggest holistic approaches to the risk is that, take a traditional company. Let's just say like a retail dining shop across 50 states, and you have a board of directors that sits above a suite of managers that sits above a suite of people who manage cities, who sit above individual managers for each restaurant, who sit above their employees. When there is a situation, lawsuit, let's say sexual harassment, not that it's the prettiest thing in the world, but let's just use it for example purposes. Drawing that negligence of that situation back to the board of directors is a very difficult task, because you have a sea of management and honestly a game of telephone in between them and the ultimate person who committed the issue. Now, as you get higher in the food chain, it gets easier to tie to management, because it could be an environment, a toxic environment, and that's generally how those things go. The reason I use this analogy within AVs is that when you have a board of directors that's involved in an AV company, you are directly tied to your technology. There is no middleman. There is no person who is administering your vision. You are directly administering your vision, your operation through your technology. Your duties and your responsibilities as a board of directors are much more heavily involved in the business. You are much closer to the product you're delivering because it's a digitalized product. And so the way I approach this is, yes, could this make auto liability, I hope, much, much, much easier for operators across the board to really flourish. It's going to bring across other considerations that, might not necessarily be predictable unless we have more precedents to be set. How many precedents do we have about board of director negligence with regards to autonomous vehicles? We don't have a lot. How many derivative demand suits do we have? And by that, derivative demand suit is usually in a D&O context. That is when an outside investor sues the board of directors on behalf of the company because they don't like a decision they made. The stock price went down. I didn't like you did this. That decision could have been made in good faith, but that's, a very common claim that's filed these days. So, I think, again, wrapping that whole conversation up, the auto liability, GL side, a lot of these things could see some easement from a lot of the value AV provides. But the IP and the analogy I mentioned before about just how directly involved you are with your product, or at least the degrees of separation that no longer exist within the niche, really will present some interesting considerations.
We have to take a holistic approach to it. Earlier, you mentioned the SAE Level 2 electric vehicles that you can buy today, which are not self-drive, but they have advanced ADAS features on, being 26 to 27% more expensive to insure. How much of that is the component hardware and the battery cost of replacement? And then, frankly, what we saw, unfortunately, in New York City, the weight of the vehicle, that's taking a taxing toll on infrastructure that we're not prepared for that. How much of all that goes into raising that insurance rate?
Well, that's a general increase. I think that depending on if you're talking about substandard or standard carriers, and are you talking about your Chubbs, your Liberty Mutuals, your State Farms of the world, or are we talking about some of the substandard carriers? Because across the board, the general mentality is it's riskier. Could I tell you in one sentence which carriers are actually using quantifiable metrics to come up with that increase? I couldn't tell you. I don't know if they are. I don't know if, I think it really depends on the sophistication level of the personal lines insurer involved. And so I think that's a general 26%. I think that's a general value of vehicle increase alone. I think that they are, in most current states, probably not evaluating a lot of the benefits or maybe risks involved with the AV components. I think a lot of that comes down to the battery, comes down to the value of the vehicle. And, hate to make it as simple as that. But again, one of the things that I deal with a lot in my corporate insurance career is the glacial pace at which insurance in general moves. And so it wouldn't surprise me if the way the tables are put together on a personal lines basis are that simple.
Something has to give. There was an interesting report from Edmunds that came out today. Owning an EV is more expensive than an internal combustion engine. So you mentioned 26 to 27% more for the insurance. The vehicle's more expensive. You're looking at $10,000 to $15,000 more. The Inflation Reduction Act is a complete, how do I want to say this? Very difficult to understand. You're not getting the tax breaks that the consumers thought they were going to get. You're going to see consumers shift back to the ICE vehicle just because of the cost savings. That's going to get really interesting. Okay, so let's just say consumers say the EV is too expensive. I'm going back to internal combustion engine. Now, does that 26 to 27% insurance increase, does that go to, say, 35 to 36% increase because there's less of them in the market, so there's more concentrated risk?
That's a great question. Another statistic I read recently, Grayson, is that there will be another ballooning of used ICE vehicle prices in Q3 this year. So they will once again go up in price. So it's certainly not if you're looking for a vehicle these days, it certainly, I would say that's maybe one of the core reasons why subscription car models are doing so well these days, is because it's pretty dang hard to get a vehicle, whether you want an IC or an EV. I've even had some circles mention to me it's more difficult now to get an IC than an EV, which is a little crazy considering the direction our country's been headed in for the last three years. So yeah, there's all bets are off. There's no guarantees. What carrier are you working with, and how are they going to address a move from you having an EV to now an ICE? That I think the bigger, honestly, now that I'm thinking about this with you, the biggest consideration within that is gap coverage. So when you have physical damage coverage on your vehicle, if you buy your car in the lot, you drive it off the lot, it gets totaled, you run the risk of the insurer replacing that car at actual cash value. And that actual cash value might not be what you paid for at the dealership. And quite frankly, it won't be. And so in this situation you're describing, where you're going back to an ICE, whether you buy it at a dealership, used car, CarMax, whatever, you have that put on your policy, and you have this environment where the actual cash value of the vehicle is incredibly fluid. There's a huge, and by the way, gap coverage used to be 10 years ago, 5 years ago, a very common inclusion when you purchase a car from an OEM, at least. You go to used car lots and, you kind of run a little bit of a gamble there with various different brands. But if you're going to, a franchised OEM dealership, license, et cetera, most times you could buy that stuff. These days, when you're scrapping to buy cars in a market, maybe the reliance on that factor in the equation just isn't there anymore. So getting back to your question on the insurance, like maybe you'll be able to insure it for the same price. Maybe you'll get a discount. But what if you total that vehicle and the value of that vehicle, according to the insurance company, is much less than the inflated price you just paid in our market because of market pressures? That to me would be the biggest consideration for anyone that's going in that direction. And I would definitely encourage you to talk to whoever is helping you with your insurance to make sure you've got some sort of gap protection in there to avoid that type of rainy day, because you bite the bullet on that one and then have to, you're $10,000 in the hole. But that's not especially if you financed it, that's in this rate environment, that's no fun situation.
No, it goes back to the old saying, don't fight the Fed, because they're probably going to go another 25 basis points and hold there. So it's very expensive. What we've clearly talked about today, the insurance market's complex. There's a lot of risk that the insurance market's covering for, especially on the general liability side, which you refer to as GL, and the automotive side. I'm really curious, when you look at an insurance company as an underwriter, not necessarily a broker, we're insuring autonomous vehicles, autonomous trucks, delivery robots, ride-sharing, gig-sharing, traditional general auto, commercial auto. How do the underwriters get experience across the board to properly price this risk, since these, frankly, are all niche specialties?
It's a delicate song and dance, to say the least. So it is, luckily, we've moved in a direction where there are carriers currently practicing and operating and coming at it with the right attitude of, we want to be market leaders here. We're going to take this as a bullish segment that we want to get good at. And so some of them have taken their hits there. There are a subset of carriers where even I've seen over the past 2 years, costs actually kind of come down a little bit. Believe it or not, there's even some state funds. California has a state-funded carrier that will write some of this stuff. There are options out there. There are folks taking chances at it. It's very regional. But, this is a place where you have to have a strong specialized team on the insurance front from a broker's perspective to make sure you're talking to the right teams of carriers who are testing their hand at the space. Trucking
is going to create jobs. It's going to have a positive economic impact. Look at the spot market. It's tanking. UPS was down 10% the other day. The shipping rate market is absolutely tanking. So you want to talk about jobs? Okay, so we're going to need an individual to launch the autonomous truck. That's a job. An individual to maintain it. That's 2 jobs. For one job, we create 2 and 3 jobs. Same thing happened with the cell phones. It's all going to happen. It just comes down to messaging. But more importantly, from an economic standpoint, if you can go to a family that's struggling because of runaway inflation, by the way, that's not transitory, it's sticky, that, hey, because of the autonomous truck, we can lower the price of milk. We can lower the price of your groceries. We can lower the price of your household necessities. That's a win for the American economy. And by the way, if deployed properly, which California doesn't understand because it's driven by politics, not by economics, autonomous trucking will lower inflation. It's good for the economy. That's where we're going.
Fully agree. And I'm excited to see it in action.
Absolutely.
On a micro scale, one of the things I wish I could see more is you see a lot of these, this is kind of mini trucking, but like you see many of these devices these days delivering items, like for, on a DoorDash, Postmates, so on. So these little containers showing up. I'm getting notifications sometimes when I order, like, you might have this delivered by a little robot, and then a person shows up, and then I'm disappointed. Because I'm just like, you're getting to a situation where, maybe this robot's probably going to do a better job. They might not get lost. They might not be able to, they might not miss the door. They might not have to park. You're removing so many cost structures from the system and driving efficiency at the same time. And it just cannot be discounted whatsoever. On my side of the equation too, it does the same thing with the insurance. The more we do it, the better, smarter we get at it, the more carriers can make money at it, the more carriers show up, the more competitive the market gets.
Competitive markets or healthy markets, putting this whole conversation together, Ed, in your opinion, what is the future of insurance?
That's a broad question. The future of insurance is going to rely upon innovation and breaking of old habits. And I think I mentioned earlier that insurance moves at a glacial pace. It most assuredly does. I say this as a person in the trenches every day with this. pushing against, I don't want to call it the old guard, but pushing against the old wave of underwriting and the knowledge they've captured. A part of the difficulty is convincing them that data might no longer be relevant. There might be pieces of the data that are, but on the whole, I think the market itself today has proven that many of those models are antiquated and no longer work. So innovation is going to be key. I think, sadly, what I've seen a trend of is a lot of new insurtechs really struggle, burn and fail, and I'm rooting for them. And I'm rooting for them from the pure aspect of the blue bloods in corporate insurance and in personal insurance are never going to be the drivers of innovation. They're not going to do it. They want the young people, the young entrepreneurs, the tech individuals to come in with their solution and they can buy it. They just want to come in. They want someone to do it for them. And then they will take it up as long as you can prove it to them. And unfortunately, that's proven to be a very difficult task. Especially we mentioned earlier, like the subscription model, bring your own insurance move. Do I think on just a practical level that because someone's not on the registration, a claim shouldn't be paid? No, I think that's total BS. Okay. That to me is antiquated policy language that obviously should be revisited. Because Grayson, full disclosure, I've asked underwriters point blank, why is, just on a regular business use case, why is this here? And, I get a very big sea of answers there, a lot of which come back to, well, California wants us to do that, or, so on and so forth. So some of these things are not, don't have tangible reasons for existing. I mean, I'm sure there might be a good response somewhere, but the point is there needs to be change, and there needs to be quick change and innovation, and it needs to be fostered and not squandered, which can sometimes be the mentality from a lot of corners of corporate and personal insurance. That's very ambitious. Thank you very much. Have a nice day. And that's an attitude we need to get away from.
The bottom line is innovation creates jobs. Innovation's good for the economy. Let's look at the S&P market cap from the top. Apple, Microsoft, Google. What do they have in common? Innovation. Look at the hundreds of thousands of jobs that they created directly and the millions of jobs that they created indirectly. Innovation creates jobs. Innovation is good for the economy. And Ed, as we look to wrap up this insightful conversation where you shared really great insight into the bring your own insurance and the whole insurance markets as a whole, what would you like our listeners to take away with them today?
We certainly hit on all of the things that are negative. And I would say that I think a big thing everyone should take from this conversation is that there are good minds at this and they're aware of the issues. And we're pushing the envelope every single day to improve this situation for everyone, both consumers and operators. And in that limelight, I would recommend to stay positive with this, to not make, on a fleet side, do not make hasty decisions because your renewal was nasty or because your competitor tried this or that. Stay steady, invest in your drivers, invest in understanding your drivers and who you're putting on your platform. And there is a way to profitability. There is a way to make this work as long as you're working with the right team in insurance. And in consumers, I do want to play with the positive attitude to say, hey, if you need to do a dongle in your car, it isn't the end of the world. Be open-minded, try various things. If you hate shop your insurance, get smart about it, get involved. We're no longer in a state where we can sort of just go to the websites and enter this in and be like, all right, that one looks good. I'll join this affinity program just so I get $5 off or whatever. I think it's unfortunately not the most fun exercise to spend 20, 30 minutes of your day doing. But I think my message would be across the board for businesses and people. Now's the time to understand what you do every day and what kind of risk implications that has. And, read through your policies and spend 30 minutes just understanding what you're doing. And for businesses, obviously spend a little bit more time than 30 minutes, but I want to keep this, topical. The outlook is promising as long as the community at large brings the decisions behind insurance into more of the limelight of their own lives. It is not a set it and forget it situation anymore. You need to invest time in it, whether you're a person or a business.
Absolutely. The bottom line is insurance is an innovative business. It all goes back to London at Lloyd's Coffee Shop from the Maritime, which became Lloyd's of London, and they do great insurance. There's really great individuals working insurance. There's great insurance companies. There's just Unfortunately, a lot of issues around socioeconomics that impact it. But the bottom line is, invest in great insurance. You won't regret it. The future is bright. The future is autonomous. The future is insurance innovation. Ed, thank you so much for coming on the road to autonomy today.
Thank you, Grayson. Appreciate it.
Thank you for listening to The Road to Autonomy. If you've enjoyed listening, please kindly rate, review, and subscribe on your favorite podcast platform. Want to get in touch? Follow us on Twitter, Instagram, and YouTube at Road to Autonomy, or email podcast@roadtoautonomy.com. The Road to Autonomy podcast is produced by the Road to Autonomy LLC. The views and opinions expressed in the Road to Autonomy podcast do not necessarily reflect those views of the Road to Autonomy, its subsidiaries, its shareholders, directors, investors, or partners. The content discussed on this podcast is for informational purposes only. It should not be taken as legal, investment, tax, or business advice. Nothing is a recommendation that you purchase, sell, or hold any security or other investment, or that you pursue any investment style or strategy. The content of this podcast is presented on an as-is basis with no warranties, express or implied, of any kind. Financial mentions about companies in the Road to Autonomy Index and discussions about the Road to Autonomy Indexes are for informational purposes only and should not be relied upon when making any investment decision. Furthermore, an inclusion of security within the Road to Autonomy Index is not a recommendation by the Road to Autonomy Indices, LLC, to buy, sell, or hold that such security, nor is it considered to be investment advice.